It's like a Nirvana for an active bond manager. It's like a global bond buffet. There's so much to do.
Right.
It hasn't been a global bond market in a long time because, as you said, interest rates were low, and they were low everywhere in
Yeah.
the 2010s, near zero, pinned near zero. So there wasn't much to do. Now there's so many things moving around like butterflies. You simply take your net, try to find the good ones, and put them in your collection. So we'd say that lower your fears and anxieties. First, I'd say there's three things not to do. One, don't try to time the market. Yields are high. They look very good historically, very good versus expected inflation in the twos, and versus what's typical volatility. So I'd say, generally speaking, you want to be enamored by the bond market opportunities today and lock in today's interest rates. It's total return time. It's time to think about something beyond the yield, potential price gains, and that's what total return strategies are. And that could be, and I don't mean a fund, but I mean the idea of potential gains in prices is what you want, and to put those yields higher, the returns higher.
So where do I go, Tony? I mean, I can just go right outside right now and get a 2-year treasury at 4.8%. Do I do that, or do I go out and maybe take some more credit risk here? How are you guys thinking about it?
Well, intermediate maturities are probably the sweet spot. And the Bloomberg aggregate, which is a compilation of lots of bonds, it's sort of it's a market cap weighted index, has about 40% U.S. Treasuries, 25% agency mortgage-backed securities, and 25% corporate bonds. The average maturity on that, or duration in fancy bond language lingo, is around 6-7 years. Now, I often call those maturities, especially the 5-year, the long bond of the short end. And if you think the Federal Reserve is going to be lowering short-term interest rates, the 2-year, of course, will rally, but not as much as the 5-year will.
Right.
And so that'll really get moving when the Fed does.
My chart of the year right now, I haven't decided yet, and somebody gave it to me. Thank you out on Twitter. I'm stealing it from you. Is the yield to worst, the old Lehman Barclays, now Bloomberg index, the global yield to worst. Tony, it's out 7 standard deviations off the Volcker Great Moderation. We've had this shift in the bond market. Do we recover to some form of trend of the Great Moderation, or are we resetting a new vector
Well,
for
the bond
total
market
return?
thinks it's a new vector, looking at SOFR
What do you
futures,
think?
overnight futures. I think the likelihood is that interest rates, the 2010s is the wrong analog for thinking about the future, meaning that it's more likely that we go back to the yields of the past, than we do the 2010s. But not as high as the market's price. The market thinks the Fed won't lower its policy rate less than 4
To
for the rest of the
close the-
decade.